Investments in securities are subject to market risks. Read all related documents carefully before investing. Hello and welcome to the Weekend Investing Daily Bytes. We are shooting this episode on 5th of May and a very interesting day. The markets was set up for a huge gain up, but there was a MSCI news. MSCI, as you know, is the international index which most foreign investors follow to invest into India, and MSCI index is the primary index that is followed. So the merger between HDFC and HDFC Bank is about to take place, and there were expectations that HDFC Limited, which is already in the MSCI large cap index, HDFC Bank would also come into that large cap index, and the weight of HDFC group will go up dramatically. The numbers that are floating around say that it was expected that about $3 billion of money would flow into HDFC Bank because of MSCI inclusion of HDFC Bank into the large cap index. And as we all know, there's a lot of people who are front running all these changes. Maybe they are speculating what is going to change. Maybe they have some insider info. We don't know about that. But a lot of positions would have been built as you would have seen the price movement of HDFC Bank in the previous 2 days. A lot of position was built long into HDFC Bank, expecting that more inflows, $3 billion inflows will come in, and that will give an exit to these front runners. But what has happened is that MSCI has announced that there will be no hike of the weight of the HDFC group in the MSCI large cap index. In fact, there will be a small fall from 6.75% to about 6.5%, which will warrant a $150 to $200 million of outflow instead of $3 billion of inflow. Now the question is that we've lost almost 80,000 crores of market cap on these two names, which is much larger than what was going to be the inflow and what a small outflow could have been. So I think it is, while we can speculate if this is an insider job or big institutions are playing this game, but I think it is imperative that SEBI comes into play and investigates who all has bought this, on what kind of news upfront before this change, and who has sold today. So I think this is a market a market health issue, that if we are allowing large international speculators to run ahead, at least the regulator should know what is happening in the market. So if we take the HDFC fall out of the picture, then there was no net loss on Nifty. There was no net loss on Bank Nifty also. I mean, if the entire fall today on the Nifty and the entire fall today on Bank Nifty was due to HDFC twins only. Having said that, after a heady 6-7 days of a run up, we've had 3 days of confusion here on the Nifty. Yesterday was, of course, a dramatic update, again backed a lot by the HDFC gain. But today we've given all that up. But still, I would say nothing has been lost. We are just back to where we were, on Tuesday. Monday rather, where we were on Monday. We've just come back to that position. We still are, well above where the trend line we broke out, the neckline that we broke out. There is no concern as of now. Maybe it will become an intermediate top if we keep falling, but that is something that we will see in hindsight when it happens. But for now, the trend is very much long. For now, there is no issue as such. You can see the Nifty heat map. HDFC twins down 5.3, 5.1% each. Other banks were relatively flat. Axis Bank and ICICI Bank actually went up. IndusInd Bank, I think this has not refreshed. Maybe I'll check it again later. Uh, Infosys, HCL Tech Mahindra, and Wipro losing some ground, along with TCS, JSW, Grasim, Tata Steel also losing some ground. Maruti was the one stock that was consistently up from the morning, along with Titan. Adani picking up after a great result yesterday. L&T also up plus 1.3%. ITC also up along with Nestle. So predominantly, the hit is due to the HDFC twins. Sector wise, nothing really to see on the upside. Autos marginally at 0.4%, and most other sectors also marginal, except PSU banks, which were down 1%, metals, which were down 1.5%, private banks, of course, led by HDFC Bank, down 2.8%. So Federal Bank also came out with its numbers, almost 60 or 70% net profit gain, but the stock was smashed like anything. So the idea is that the absolute numbers don't really matter, but what is already built into the price, what is the expectation, is what changes the game, and that's how a lot of investors remain confused in terms of how to deal with the numbers being presented. Mid cap index, a bearish uh, engulfing for sure. Maybe it is time to cool off for a few days, but we may come down and maybe find support at this resistance that we broke through 4 days earlier. Small cap index has almost touched that trend line and has dropped down. Again, this looks like maybe we may get into some sort of a consolidation here as it was being expected, but nothing of any dramatic, negative consequence here. Nifty Bank, the worst hit out of all of them. The only issue here is that Nifty Bank usually leads the rest of the market in either direction. So if Nifty Bank is going to lead the market down from here, then the rest of the market also probably will follow it. But if we get out of this HDFC mess by next week, maybe we will start a fresh climb towards the previous highs. Overall, nothing has been damaged, just a minor correction after a few heavy days backed by the HDFC news. So, as I was saying, the announcement was that the factor or the adjustment was much lesser than what was expected. So, $150 million of selling versus $3 billion of buying estimate. So, my sense is that there has been some preemptive positions being built in HDFC Bank, but with this news or this statement of MSCI coming out that there will be no $3 billion of buying, all those front runners have been caught on the wrong foot, and they were, running helter skelter to sell off their position today. So the depth of this insider thesis needs to be checked. I really don't know even right now what is the delivery volumes are yet to come out for the day, but I think a lot of people will be surprised to see the analysis of what has already been built in and what has come out today. In general, I would say for most outcomes, results, corporate announcements, our market is a very porous market. A lot of news gets discounted much ahead of the market coming to know of it, and this that is why this the BBC principle Bhav Bhagwanche wins most of the time, because it is always leading up front in terms of what is the rumor and selling off on news. So this is just the intraday picture where the stock really lost from 2860 to 2700 on HDFC, and also on HDFC Bank from 1730 to 1626. On the larger picture of the bank, there is nothing wrong. There is no need for any panic. This bank is churning out 20% growth like on Excel sheet. I don't know how they do it, but it continues to do that. We've only come back to the same range where we have been for a few last months. So nothing lost, only the loss is the last few days of gain. So from that perspective, the real long-term investors who invest based on fundamentals need not worry at all. So, like I was saying, in Fed Bank's case, it was just like a waterfall fall, despite the results coming out a bit later in the day. From the very start, the Fed Bank was falling, and post the result, the fall became even steeper. So it was almost like somebody had preempted whatever result is coming back. That's what has come out. So maybe once this sale sort of gets over, or it may have just got over, I think Fed Bank may recover very, very rapidly because the results actually look quite good. Same thing happened on IndusInd Bank. So this is a sort of a banking sell-off where some institution or some portfolio of some Indian banks have been sold off. So I think this may be a very short-term based phenomena, unless the PSU banks also join this and start leading the market down, because there is definitely trouble brewing out in the US market, and this is where I wanted to also showcase some charts from the US market. This is the SPDR S&P Regional Banking ETF. So this is an ETF which is focused on regional banks in the US, and you can see the waterfall fall that this has had in the very recent past. 50% has been lost since the top here, and in very recent few weeks we've lost from 64 to 36 here, but coming close to a support here. So in the next few weeks we will know whether this support is holding or not. This is actually, you know if you correlate the events of the last many months, starting from, I think, the crypto FTX fall, and then the Silicon Valley, the Signature Bank, First Republic. So it is like a domino effect that is going on. Four or five big entities have subsequently collapsed, and you never know where the next domino will fall, which pension fund may roll over, which bank may go down. Because if you remember in 2008, I think some marquee names in banking sector. So problem happened in housing sector in 2008, but for instance, Lloyd's Bank of Great Britain, maybe with a history of almost 280 years, fell in that. There were several other European banks which had to bite the dust. If you go look back at the charts of Credit Suisse, charts of even Citibank, they have never recovered from the 2008 crisis. So banking remains the leading indicator for the market, and right now the global banking is definitely in a doldrum. So I would be, silly to say that, there are no headwinds and one should, invest in Indian equity without any concern. I think the world is full of concern right now. You must invest in equities. You must invest in global equities also, if you like to do that. But have allocation. It is very, very important that you don't be overexposed to equity at this point of time, because today's environment is being compared with great financial crisis, with the Great Depression. So we cannot take it very lightly. Maybe there's a miracle that we come out of it without a crisis, but the likelihood of that happening is very, very low, I think. So I mean, one could just get out of equity and sit out, but you never know. These things may take 10 years, 20 years to play out. So you cannot stay out also. But then, to have a excessive allocation would be, risking it too much in my view. So have a good allocation as per your, risk assessment, as per your financial advisor tells you to do. But don't forget to allocate to other asset classes, which will save you from inflation also, and for the hedging of equity uh, uh, by investing in gold or by investing in real estate, etc. So this is all I think I have for today's daily bite. Please do keep letting me know how we can improve this daily episode. We are happy to include more things here if that's what more people want. But the idea is that we share some insight about the market on a daily basis. It helps us also learn more, and maybe some of you also may learn something more out of this. Thanks. Bye.